Jules Sterling, and I'm ready to talk about why relationships are the only thing keeping these supply chains together right now.
And you're listening to Buck Reynolds. Still haven't found a digital dash that tells me more than a vibrating gear shift, but I'm here anyway.
I'm Elena Rossi, and I'm just here to make sure no one forgets that efficiency is usually just a polite word for increased liability.
And I'm Dan Miller, coming to you live from the ops room where the market is finally, and I mean finally, starting to show some backbone.
It is a busy show today, you know? After yesterday, where we were looking at those rough Q1 numbers from Universal and PAM, it's sort of a relief to see some green on the screen this morning, right?
A relief? Jules, yesterday was like watching a prevent defense fall apart in the fourth quarter. Total yardage loss. But today, we're talking about a supply-side recovery that actually has some legs.
If I may, legs is a generous term for a market that's only recovering because half the carriers went bankrupt over the last 2 years. It's a survival of the fittest, Dan, not a victory lap.
Here's the deal, Elena. Survival is the only victory that matters on the interstate. But look, we've got a lot to unpack, from GXO's big earnings to a massive new terminal in Baltimore that might actually change the East Coast hierarchy.
And we have to talk about that DHL Teamsters deal, because that 20% wage hike is, well, it's a statement, right?
It's a statement that labor costs aren't going down, which is why we need to talk about these financials first. Let's get into GXO and Cummins, because look, these guys are basically the lead blockers for the rest of the industry right now.
Lead blockers or just the ones with the best accountants? GXO just reported Q1 revenue at $3.3 billion, Dan. That's up nearly 11%.
And crushed the EPS consensus. They hit 50 cents when everyone was betting on 37. That's a massive... that's a solid beat.
Well, Patrick Kelleher mentioned a record sales pipeline of, $2.7 billion? That sort of suggests that even if the consumer is being cautious, the big retailers are doubling down on high-tech warehousing.
Actually, it suggests they're betting on reshoring. GXO is moving heavily into North American automation because they know they can't find the labor, or they can't afford it. They're absorbing the Wincanton acquisition costs, but their margins are holding because of that AI-enabled tech.
AI-enabled, every time I hear that, I just hear fewer people to help when the sorter belt snaps at 3 a.m. But look, even Cummins is raising their outlook. Sales hit $8.4 billion.
Which is wild, Buck, because North American heavy-duty truck volumes were down 20%.
Exactly. So how's an engine maker making more money when nobody's buying new rigs?
Diversification, Buck. Cummins isn't just an engine company anymore. They're a power solutions provider. They're playing the long game on parts and global markets, even while the domestic fleet market is taking a breather.
Do you think that's why the market is calling this a supply-side recovery, Dan? Sort of a new floor in pricing because the excess capacity is finally, evaporated?
That's exactly it. Look, for the last 2 years, we've had too many trucks chasing too few loads. It was a bloodbath. But now, the carrier exits from 24 and 25 have balanced the scales. We aren't seeing a demand spike. We're seeing a capacity shortage start to bite. It's like a game where 3 teams forfeited, so now the ones left on the field get to set the ticket prices.
Which means the shippers are the ones who are going to feel the squeeze. If I'm managing a risk portfolio for a mid-size carrier right now, I'm not celebrating yet. I'm looking at these price hikes and wondering if my customers are going to start looking for excuses to file claims just to recoup the margins.
Speaking of big investments and shifting scales, did you guys see the groundbreaking in Baltimore?
You mean Sparrows Point? That old Bethlehem Steel site?
Yes, they're calling it the Sparrows Point Container Terminal. It's a $1.2 billion private investment. I mean, seeing MSC and BlackRock team up on that it's a huge vote of confidence in the Mid-Atlantic, right?
BlackRock doesn't move a dime unless they think they've got a winning bracket. That terminal is going to expand Baltimore's capacity by 70%.
70% is a lot of new inbound volume, Jules. But let's look at the timeline. It's not fully operational until 2030. It's a strategic play for the next decade, not a fix for the next quarter.
Here's the play, though. If they jump to the third largest container port on the East Coast, that reshapes every lane from the coast to the Ohio Valley. You're talking about 8,000 new jobs and a total remapping of the regional haul patterns.
And it's not just Baltimore. Look at what's happening in Georgia. The Port of Brunswick is apparently the nation's busiest auto terminal again.
Oh, really? I thought Baltimore still held that crown, even after the bridge collapse.
Actually, the GPA, the Georgia Ports Authority, confirmed at the trade conference this week that Brunswick is dominating the ro-ro space. They've been aggressively expanding their docks while Baltimore was dealing with the channel recovery.
My thing is, once a shipper finds a new route that works, they don't always go back. If those car haulers found a home in Georgia while the Key Bridge was down, Baltimore's going to have to fight like hell to get that volume back.
Well, it's about that fragility we keep talking about. Lucid Motors, for example, is still being reminded that one hiccup in the chain can stall out an entire production line.
Lucid is playing a different game, Jules. They're trying to build a Ferrari in a world where everyone just wants a reliable F-150. But the port infrastructure, that's the real backbone. If we can't get the boxes off the ships, the supply-side recovery Dan's so excited about becomes a supply chain bottleneck real fast.
And don't forget the beef cliff coming out of South America.
The what? The beef cliff? Is that a new Madden play?
No, Dan. Brazil to China trade is cooling, which is forcing a massive redirection of South American protein. We're going to see a lot of that product looking for new homes in the US and EU, which means reefer capacity is going to get very weird very quickly.
Great. Just what every driver wants. More dead haul miles while the market tries to figure out where the cows are going.
Hey, before we move on to the tech side of this mess, which Elena is itching to tear apart, we need to give a quick shout out to the people who keep the lights on here.
Oh, absolutely. This show is powered by the stack developed by Eric Christensen at Neural Network Media. Strategic logistics, it really does require world-class engineering. And Eric is the architect behind the code that lets us do this every day.
If you want to support the man behind the curtain and get a little extra for your own fleet management, visit our Patreon at patreon.com/Neural Network Media.
You can get a free trial and access to our daily briefing PDF, which, let's be honest, has much better grammar than Dan's sports metaphors.
Hey, my metaphors are elite. But seriously, support Eric. He's the reason we aren't just shouting into a dead CB radio.
Right? Okay, so, back to the tech. Elena, you were looking at this FourKites announcement about booking Connect for Ocean?
This is where the industry is moving, Jules. It's no longer just about productivity AI, telling you where a ship is. It's moving toward agentic AI.
Agentic? Is that like it has an agent? Like a Hollywood star?
Actually, Buck, it means the AI can act on its own. FourKites is claiming they can automate the entire maritime booking life cycle. It digitizes carrier contracts, compares costs and transit times, and then, this is the part that will make Dan nervous, it executes the booking and manages the bills of lading without human intervention.
Execute? Without a human? Who's checking the surcharges? Who's making sure the historical reliability isn't just a spreadsheet error?
The agents are, Dan. Matt Allengikel said ocean booking has been stuck in the manual era for decades. Shippers are spending $100 billion a year on manual documentation. That's it's a frequent source of error and indemnity risk.
Well, I suppose if the AI is just handling the standard stuff and only flagging the exceptions for a human to look at, that's actually sort of efficient, right?
Well, here's the deal, Jules. Exception management is just a fancy way of saying I only do my job when things are already broken. I've seen these autonomous systems in the warehouse, and half the time the human has to spend 2 hours undoing what the machine did in 2 seconds.
Look, I'm a relationship guy. Freight moves on handshakes, not just code. If a booking goes sideways and it's just 2 computers talking to each other, who do I yell at to get my box on the water?
That's the change management problem they were talking about at the Gartner Symposium this week. The tech is there, but the human-in-the-loop strategy is still being written. Gartner is saying that AI layoffs might create budget room, but they don't actually deliver returns if you haven't retrained the remaining staff to work with the agents.
It reminds me of what Bissell Home Care was presenting. They're using AI not to cut heads, but to amplify the workforce. It's about letting the humans do the strategic stuff, the relationship stuff, Dan, while the software handles the surcharges.
I'll believe it when I see an AI negotiate with a grumpy peer clerk at 4:30 on a Friday.
Speaking of things people have a hard time believing, Buck, you were looking at the ACT Expo news out of Las Vegas?
Stacked uncertainty, Elena. That was the term of the week.
Stacked uncertainty? That sounds like a bad hand at the blackjack table.
You aren't far off, Jules. Matthias Karlbaum, he's the CEO over at International Motors. He basically said fleets are getting hit by a patchwork of things all at once. You've got the rollback of federal GHG standards, but then you've got these decentralized state policies in California and elsewhere. It's a regulatory mess.
And don't forget the money. Tariffs are adding $35,000 to the cost of a new truck.
$35,000 per unit?
Bottom line, yes. And that's just the tariff. Then you've got the zero-emission tax credits expiring, which were worth $40,000. So the total cost of ownership math just got punched in the gut.
Which is why Volvo is going with a 3-path strategy. They aren't just betting on battery electric anymore. They're looking at clean diesel, renewable natural gas, and hydrogen.
It sounds like they're being more pragmatic.
That's exactly it. My thing is, clean diesel is going to be the bridge for a lot longer than the green-only crowd wants to admit. 86% of vehicles might be viable for electrification in the next 5 years, but the infrastructure just isn't there. If I can't plug it in, I don't care if it's zero emission. It's just a very expensive lawn ornament.
It's a risk management nightmare. You have to buy the truck based on today's laws, but it has to survive through 5 years of regulatory shifts. I suppose that's why pragmatism is the new buzzword.
Pragmatism is just a way of saying I can't afford to be a pioneer because the arrows in my back are starting to hurt my wallet. Look, I want the tech, but I need it to make financial sense. If I'm paying a $35,000 uncertainty tax on every rig, I'm not buying until I have a clear lane.
Well, while we're talking about clear lanes, we have to talk about the DHL and Teamsters deal. This is, a 92% ratification rate. That's about as unified as labor gets.
A 20% wage increase over 4 years? Jules, that's insane. It's a massive jump.
Actually, Dan, it's a stabilization move. DHL avoided a national strike by 24 hours. Can you imagine the claims exposure if their entire U.S. Express network had gone dark on March 30th?
It would have been a lot more expensive than a 20% raise, that's for sure. But here's the thing that caught my eye. They put safeguards in the contract against AI-controlled routing.
Oh? What sort of safeguards?
The union argues that those AI routing systems undermine seniority. They basically said, you can use the computers to find the route, but you can't use them to bump a veteran driver off his preferred run. And they explicitly prohibited autonomous vehicles from taking Teamster jobs.
So they're literally banning the future? How does that work in 2030 when every other carrier is running silicon drivers to save on insurance?
It works by creating a premium service tier, Dan. DHL is betting that labor peace is worth the cost. Sean O'Brien, the Teamsters president, is calling this a new benchmark. And he's right. Every other carrier coming up for renewal is going to see this DHL contract as the starting line, not the finish line.
Well, if it prevents a strike and keeps the warehouse running, it's sort of a win for the clients, right? I mean, reliability is the number one thing my retail accounts ask for. They'll pay a bit more if they know the box is actually going to move.
Here's the deal, though. If we keep banning the tech that makes us more efficient, we're just going to keep seeing these 10% and 11% revenue jumps with flat volumes. It's all just inflation at that point.
Oh, it's not just inflation, Buck. It's a game of chicken. The unions want to protect the jobs, the carriers want to automate the costs, and the shippers are just caught in the middle trying to figure out if they should buy a fleet of their own or just trust the Iron Lady here to handle their claims.
Trusting me is always the safer bet, Dan.
Honestly, it is. But seriously, seeing DHL get this done is, well, it's a relief for the market. It signals 4 years of labor peace for a major player. After all the uncertainty in the LTL space last year, this feels like a return to some kind of normalcy.
Normalcy. I remember that. It was usually followed by a tire blowout and a rainstorm, but it was nice while it lasted.
I suppose we'll see if this benchmarking spreads to the rail side, too. If they start putting AI safeguards in rail contracts, that great connection merger between Union Pacific and Norfolk Southern we talked about yesterday might get even more complicated.
Well, that's quite a docket for a Wednesday morning.
Here's the operational takeaway for the folks starting their week. If you're a fleet manager, don't get distracted by the 20% headlines. Focus on your fuel surcharge math and your maintenance cycles. These uncertainty taxes on new rigs mean your current fleet has to last longer than you planned. Keep those shop doors open.
And keep an eye on those spot rates. The supply side recovery is real, but it's a game of inches right now. Don't go deep into the end zone without a clear route.
And remember, behind every one of those agentic AI bookings is a human relationship that still matters when the exception hits.
And when it does hit, make sure your documentation is digital, because a computer doesn't care about your excuses, but a judge does.
Thanks for joining us in the Ops Room. I'm Jules Sterling.
I'm Dan Miller. See you on the yard.
Elena Rossi, signing off. Stay compliant.
I'm Buck Reynolds. Keep the shiny side up and watch your mirrors. Somebody's always moving faster than they ought to.